Welcome back, everyone. We surely hope you've enjoyed the presentations you've heard so far. And now for the next leg of our event today, we have a very interesting panel discussion for you. On today's panel, we've got Nick from Ford Asset Management, Omri Thomas from Apex Investments, and Saul Miller from Truffle Asset Management, of course, our best of breed partners. So just to kick things off, gents, thank you for your insights today. Really great to hear them. Certainly wishing you all the best for the rest of the market. It's been a stonking start to the market. Certainly quite a reversal from last year. I mean, if we think back to January last year, one of the worst on record. This year, we're up nearly 10%. And it's, I think we've hit, all-time highs just a week ago, 2 weeks into January. I mean, just your overall thoughts on the sort of the good run we've seen. I know we've given you insights, what you're thinking, but this type of run, are you positive? Maybe we'll start with you, Saul.
Sure. So yeah, I think the markets have run quite strongly from the start of this year because of the China reopening. As a result, you've had a lot of commodities running like iron ore and copper. That's been good for SA miners that make up a large portion of the JSE. We've had other shares on the JSE that also benefit from this reopening, the likes of Richemont, where nearly 30% of their purchases come from Chinese consumers that are now finally being let out of their buildings or their houses. So I think that's something that's positive, and it'll probably continue since I think we're in the early phases of this reopening. Obviously, all of the SA markets benefits to some extent because EM markets generally benefit as a result of China opening up. So you get flows into the all share as a whole. So that might also drag up some of our domestic shares. There obviously are some issues for some of the domestic counters like load shedding, which is one of our own goals, and that might sort of hold some of the domestically exposed businesses back a little bit. And we'll really have to see if we can get on top of this load shedding issue to see if they can also participate in the rally going forward.
Thanks so much for that, Saul. And, I suppose we can't not talk about China, but I'll park that one for the minute. I just want to talk about, in the context of the current market dynamics, we're seeing high inflation, high interest rates, yet, the market is pricing in a much more sort of rosier outlook. Do you think it's a good time to be adding to investments, just given, as I mentioned, we just hit all-time highs just a week ago? Where do we go from here? Maybe I'll lob that one to you, Nick.
Yeah, I won't make a comment whether you should be adding or not. It would depend on the person's kind of personal circumstances. But I think it's a hard one because, as I said in my presentation, we think actually that a lot of the good news is starting to be built into the US market. If you think about the implied inflation at 2%, in the US, it's already saying it's pretty rosy that we're going to get this Goldilocks world back, where the world's going to grow and inflation's going to be benign. But actually what will probably happen is if the world continues to grow and we do have a soft landing, there's a chance that inflation surprises. And it could be the thing that surprises people, that you can't have everything. You can't have the growth with low inflation. So technically it might be fine, but I do want to caution that we aren't just off to the races and it's just into a new bull market right now. To be honest, it's dependent on many variables that might or might not work in your favor.
Yeah, I think I read a statistic. The bear market rallies, they're often the sharpest, but that's how often you sort of get trapped in that, right? Yeah. Coming back to China, you've got quite a big tech position, Omri, in your fund. Are you still very bullish on China? I know, we had a panel last quarter at the last event, and it just shows sort of almost the unpredictable nature of markets, how quickly the news flow can change, sentiment can change. China, again, up 10%, year to date. Much more than that if we look since the end of November. But you're still very much bullish?
Yeah, I mean, if you look at the valuations of some of those companies, they really got hammered. I mean, they were down 70, 80% from their highs. And at some of these companies were trading at below cash levels. So your margin of safety was quite high, and that's why we entered specifically Chinese tech platform companies, which has got a sort of a wide base and which we see as a growth industry. So there's been a significant recovery. Some of those shares have doubled. But when you've fallen 80, 90%, you double, you're still way off the high. So, I mean, from portfolio construction, we've reduced the size of the position just from risk management point of view, but we still see some value in there. I think coming back to what both Saul and Nick said, I think another driver of the market and of the strong start to the year that we've seen is this expectation, and Nick referred to it, that inflation is going to moderate. And there was very much a concern last year that we go into this massive inflation environment. Global central banks just have to continue increasing, putting a real dampener on growth and driving the world into recession. The story is, the narrative has changed with China reopening, inflation coming down, and it's all hunky-dory. We must admit that global rates are a lot higher than where they were the last 3, 4, 5 years. And the markets have to start to adjust and digest that. A lot of refinancing that has to happen. So I don't think it's a one-way bet. One has to be cautious in your approach.
Thanks for that, Omri. Maybe Saul, has your view perhaps changed since the last time on China?
I think our view has certainly changed a bit on China. I mean, we'd been reasonably optimistic on China earlier last year, and then into the Congress, or the 20th Party Conference, we thought that was pretty pessimistic. We thought the speech that came out of that was especially pessimistic. And then, I guess, due to social pressures and social unrest, the economy opened up a lot quicker than we would have expected. There were changes which we didn't expect, the easing up on credit for the property developers, and just the market becoming a bit more friendly in terms of allowing rights issues for Ant. So things changed for us quite a bit, I'd say, in that month post the end of the Party Congress, and so that did give us a bit more optimism. We were always reasonably optimistic on the country eventually reopening. So we've always been reasonably optimistic on commodities getting a benefit from that. We were a bit more concerned about some of the Chinese shares, where the concerns that I think there still needs to be some concerns around China and around risk premiums in that market. We have seen some fairly negative things happening in the last few years, where we've had certain sectors that have been shut down. I certainly don't think it deserves the same risk premium as some of the developed markets. There are definitely risks to that market, which I think changes the kind of valuations we would apply to a Chinese market today than what we might have used historically. So that's important. But notwithstanding that, we're definitely seeing a reopening of that economy, and at least in the short term, that should benefit shares that supply into China. I mean, in terms of the US, that's something we've certainly been worried about for quite some time, and I'd agree with the comments made that given where rates are today, I think that warrants a lower valuation for the US market. I mean, we've just had unrealistically low real rates for the last 10 years, and it needs to go back to where it's been for the prior 100, which is probably something closer to real GDP growth of 1 to 2%, and that would worry us in terms of the US market.
Thanks, Saul. Perhaps Nick, your perspective?
Actually, yeah, I think I've kind of alluded to it, but I think we're kind of along the same lines. I'm cautious to say we're China bulls in a way, but it was just where the value was at, as Omri said. I mean, you're not being paid to take the risk because you're getting these companies on single digits. So you didn't even need the opening to justify the valuation. And the good thing is they were all buying back their own shares. So it actually added to the advantage in that they were kind of benefiting the long term of the company by what happened. So yeah, I know we continue to be positive on it. And it's quite an interesting thing, because if you speak to global investors, it's still very under-owned. Talk to any American, talk to any European. I mean, either it's regulation or persuasion or whatever, or waiting for the turn. They're not there yet. So there is a chance that the money on the sideline still has to join the party.
Thank you for that. And that brings me sort of to the next part of that conversation. Omri, you mentioned the fear of inflation last year, but it seems that's starting to recede. Of inflation we're seeing starting to roll over slightly. So the other part of the equation being the energy trade. And that a lot of that was driven now, with oil falling, fears of global recession, but of course being opposed by this drive in China. Do you think there's still legs, for the energy complex as a whole, and that's coal and oil? Maybe I'll start with you, Saul.
Sure. So I think coal's done tremendously well. It probably did too well. I mean, it reached multiples of where it's traded historically. So I think it's not surprising that it's coming down, and I guess that's partly linked to European natural gas prices that also just reached ridiculously high levels, and we're now seeing that coming down. So I'd say coal from here is still quite elevated. I wouldn't necessarily expect it to, at least on a medium-term view, to rise from here. I think oil is reasonably low, so we've seen a lot of commodities rising quite aggressively. Oil's actually been quite disappointing, and that's probably despite a lot of low stock levels in many countries. Given that we've got the reopening of China as well, that should certainly add to demand, another 1.5 to 2 million barrels of demand, which should also be positive. So we think that's actually an area where you could really see some really positive movement in share prices from industries that obviously profit off oil. Whether they drillers or whether they are service businesses, we think that's the one part of the commodity complex that is yet to run. And the shares we would say, are also pretty cheap at this stage as well.
Omri?
No, I would support that. I think oil specifically, you've got a depleting resource. There's been some artificial factors boosting supply and depressing demand. Boosting supply in the sense that the U.S. government has released a lot of barrels of oil from the special petroleum reserves, and it's now at a decade low levels, so they have to restock that. So that's an additional source of demand coming through. And then you've got the Chinese reopening, which, as Saul said, will probably add quite a bit to oil demand into an environment where, because of ESG pressures, there hasn't been really significant investment in new capacity. So I mean, that supply-demand balance is definitely in favor of a higher oil price. So maybe the oil price doesn't go higher from here, but it supports a very high level of oil, and that's where it was a driver of inflation last year, because of the rollover. That's been a driver of disinflation or low inflation, and that can quickly turn around again if we see a rapidly increasing oil price. So oil price very important for determining the inflation outlook.
Nick, I'm going to ask you, locally, we obviously have Sasol as the oil play. Anything else in the world maybe that you're hearing from your global counterparts that's looking quite interesting in the oil space?
Yeah, I think Saul alluded to it. One thing that we have added to the stable fund, and I did speak about it in my presentation, is the Sasol convertible is still very interesting to us. So you can talk about Sasol and all the kind of risks that's happened at the recent production numbers, which weren't amazing, but you paid 4.5% while you're waiting, and effectively the exercise price is, if you include all the dividends you're going to receive, at spot. So I think that one is actually very interesting, and it has the downside protection. Obviously, you get your face value back at the end of the term. But globally, we're the same. We're looking at not only the oil companies, but the companies that service the oil industry. One of the companies we do own is a seismic. It does all the seismic photographs of the different areas. And as people struggle to find the additional oil, which is obviously due to all the underinvestment that's going to pick up, they are, I guess, in a very strong position. It's an oligopoly in that area. So they do have a bit of pricing power more recently. So always find the guy that digs the shovel for the miner. It's a safer way to play the industry.
For sure. Picks and shovels.
Yeah.
I'd like to get your views on gold. I know for Nick, it's been a core position in the stable for you for a long time. You've had exposure via the miners or the metals. I think, Omri, I don't think at the moment you have any gold exposure. Saul, you've got Anglo Gold Shanti. For the last year or so, with inflation raging, it hasn't really played that inflation hedge role. So just want to get your views on why that was, and sort of what is the actual role of gold in a portfolio, maybe. Nick?
Yeah, I think it plays numerous roles at different times, depending on how I feel. No, I think the key point is it's previously you held it and there was pretty much no cost to holding it because interest rates were nothing, and it was a free option on insurance for the portfolio. And, should inflation get out of control, that's why you kind of previously owned it. I think more recently there is becoming a cost to owning it as interest rates do increase. And that obviously generally is a headwind to the gold price. And interestingly enough, through that, you've seen strength in the gold price. And the reason for that is that if you're sitting in Russia, you're sitting in Saudi, you're sitting in China, and you see that the Americans freeze the Russian assets out of the blue that's sitting in the kind of US market or the European market, the first thing you're thinking is, how do I actually deal with that should it come to pass for my country? Well, the best way to do it is to buy gold and put it in your country. So that's what we've seen is some central bank buying, which is acting counterintuitively to, I guess, higher interest rates. So I think I have seen a resilient gold price. There is that sort of dynamic that's going on. It's a position that's 4% in the portfolio. As I said, there's a small cost to the insurance that we own right now, but we do think there is a bit of momentum around what I'm speaking about more recently.
Thanks, Nick. Maybe Saul, your views on the gold?
I'd agree with most of those comments. Gold's recently run up quite aggressively, and that probably is because real rates have actually come down a little bit. If we look at the 10-year real rate, where there seems to have been quite a strong correlation for the last 20 years or so. So we've seen some of that benefit. Some of it's probably been driven by a weaker dollar as well, which obviously matters since gold is priced in dollars. So we currently see a bit more upside in some of the other commodities. We have a bit higher conviction in some of the other commodities where there's drivers that we feel a bit more strongly at, really talking to this China reopening theme that we spoke about. I definitely worry about the fact that real rates now are at a reasonable sort of level, so that might hold back gold. I think you're going to need some fairly serious inflation to get gold price going meaningfully higher. It's not clear whether we're going to see sustainable, very high levels of inflation. I mean, you might get levels that are certainly well above the 2% that's being imputed in bond markets, but whether 3 or 4 is enough to drive gold to much higher levels isn't clear to me at this stage.
Omri, you don't own any, as mentioned, at this point in time. I've seen a few other interesting resource stocks in your portfolio. Maybe just want to touch on those. I think Merafi is one, which is chrome. Just your thoughts on some of the more interesting commodities.
Maybe just to start off with gold. I mean, if you had to paint a perfect scenario for a rising gold price, that would have probably been what we saw last year. High inflation rates, rising inflation rates, geopolitical unrest. The gold price was actually quite disappointing. I think Nick makes a good point why there's been sort of additional sources of demand. But I mean, it was disappointing from a portfolio construction point of view in terms of where you would normally buy it as a hedge for inflation and for weakening currencies. It didn't really fulfill that role, but more recently that's been strong. Merafi is a specific stock pick which is just extremely cheap. Cash on the balance sheet, trading at a 3 PE. There's always a potential that they can be taken out. It's a small position, but I think it plays its role. And then the other sort of quite smallish commodity exposure is Thungela, which I've spoken about earlier, which despite gold prices coming down, even at current levels, still earning significant amount of cash and a lot of cash on the balance sheet. They've already guided to what they're going to earn. So the shares trading probably on a 3 to 4 PE, even at current gold prices, and we think it's nice optionality for the energy complex and for if commodities continue to run.
Thanks, Omri. Now, for the benefit of our viewers and their end clients, I want to talk a bit about building resilience. That can apply to many things. But in this context, I think for successful investing, as we know, it requires 2 things. For active management, at least, picking the right stocks, the right sectors, the right assets. And the second part of that equation is the behavior that goes along with that. Now, you are portfolio managers, which is by no means an easy job. You're responsible, I think, but between the 3 of you for billions of assets under your direct control. And if you think about the last 3 years, it's been really difficult to manage money. We saw, the shock of 2020, markets racing off, very difficult 2022. and the mental fortitude and the emotional, strength that you need to get through that with a clear head. I just want to ask your advice, for clients, what they can do to see them through very difficult and volatile periods. How can they build this resilience, to sort of see through the volatility and stick to the plan? I'll start with you, Omri. I think you've been in the markets, I think, the longest here. So,
no, Mansur, that's a very good question, and a question that's always difficult to answer after difficult markets. It's always after you've had good returns, you feel like, no, but it's an easy game. But after difficult markets, it's a difficult question to answer. But I think you mentioned it is, if you do your proper analysis in terms of your risk profile and your investment horizon, and you get a properly structured plan by a financial planner that's got experience and that does his job well, it's to stick to that plan, because at the wrong points in time you'll panic, and that's the quality of a true long-term investor, to not do the wrong things at the wrong point in time, not to after the fact sell the market, or after the markets got to new highs to then commit new capital to the markets. And I think where we are as South African investors, we are in the fortunate position that a lot of the building blocks that one can use to construct a portfolio at the moment actually gives you these reasonable returns. I mean, if you start from cash, bonds, SA equities, and even foreign equities, I think one can achieve a portfolio that's inflation beating from this point onwards, despite the warning signs and the short-term concerns. In the long term, I think one can still construct an inflation-beating portfolio.
Nick?
Yeah, I think Omri answered it quite well. I don't need to kind of add a lot, because I think that I agree with a lot of what he was saying. But I think it comes down to how we have confidence in what we're doing, because we're also taking that long-term view. We're making sure that our portfolio turnover is less than 20%. We're holding things for 5 years. The key point is, when you invest with us, at least we know that fundamentally we're looking after you because we're buying income streams that we trust. We're not trying to guess share prices. And if you do that correctly, then you have confidence in the future, as Omri said, that there can be Mr. Market that can do whatever they want to your share and your share portfolio. But through time, if you're buying the right things and you're buying income streams, it will absolutely come through. But it does fit exactly with what he said. Is it comes down to, have you had a plan that suits you? The risk. The important thing is, when you structure your plan, can you take that downside, because some people can't, and then have to liquidate at the wrong time. So I think it's all about understanding what you can and can't do, and don't go into an equity fund if you need the money in 6 months' time. So I mean, that's just a natural stuff that people should be looking at.
Thanks, Nick. So, some gems of wisdom.
I'd really agree with all those comments. I mean, I guess the only thing I'd add is that the stock market over the long term does much better than cash. So you want to be in the stock market over the long term, and we're taking timing out of that. If you're putting a regular amount of money aside every month or every couple of months, and you take a reasonable length of time, probably something more than 10 years, you are going to do all right. So without worrying about timing, whether it works or whether it doesn't work, you will do well by doing that. So I think that's really, really key. And then, I mean, in terms of us, and I'm sure it's the same as what you guys were saying, we're going to try and avoid investments that are especially expensive. You want to try and buy income streams that are reasonable. So you're adding that into the mix. That should certainly give you very healthy returns if the long-term past is anything to go by.
Thank you so much for that, Saul. On that note, we're just about out of time. We certainly hope you enjoyed those insights. Just before we sign off, I just want to congratulate all of you again on a stellar year in what was, as I mentioned earlier, a very difficult 2022. Your portfolios performed exceptionally well, and we're glad to have you as our best of breed partners. So thank you for your time. Thank you for your insights.
Thank you.
Thank you.